sluggish growth. Global economy is actually reviving. The deal pipeline is quite strong today, and you also have a tailwind in terms of rupee depreciation, which has depreciated quite rapidly in the last 6 months. So at least for next 2-3 quarters, you will also have a tailwind from rupee depreciation. So all in all, this is a sector which has better revenue momentum, better profitability momentum compared to pharma as well as FMCG. But in terms of valuation, this is more attractive than FMCG or pharma, simply because if you set aside TCS, all other stocks, including Infosys, are quoting anywhere between 12 to 15 times 1 year forward, which is more or less in line with overall market valuations, whereas pharma and FMCG are at 20 times or 25 times. So within the defensive basket, we are more keen to look at IT as one of the choice sectors. Among the cyclicals, we believe the entire picture is quite different. There are companies where the distress is too high, the balance sheet has been broken completely, the interest burden is quite high. For example, 1/3 of the Indian companies today have an interest cover of less than 1, which means their interest burden is higher than their EBITDA. So that is the basket which will clearly take time to revive, because the interest rates will have to come off very significantly for that basket to do well. And most of these companies also have a kind of interference from the government, either in terms of order book, either in terms of policy, or some approvals getting delayed from the government, etc. So I think you need to be careful when you are picking non-defensive spot. You should be looking at only sectors which are reasonably balanced in terms of their debt to equity capital structure, and also which are very well managed with reasonable amount of growth and earnings visibility. So for that reason, we are currently focusing on 2 sectors, which in case economy revives as we expect, will be the first round of beneficiaries with no stress in the balance sheets. That is private sector banks and auto ancillaries. I think these 2 sectors will definitely participate in any recovery that we will see. Automobiles and auto ancillaries, for example, for the last 3.5 years have been seeing negative or a nominal growth, and the valuations are very fair. They also have some amount of hedge, because most of them also have export revenues. And in case of a recovery, obviously their operating leverage is much higher than the FMCG sector. So we believe it's kind of a very good balance when we have underweight on FMCG and overweight on auto and auto ancillaries. Now moving to the products, Kotak 50, which is in the next few slides. Kotak 50, as you all know, is a product which is a large cap oriented product. We can move to the next slide, please. It's a large cap oriented portfolio with 80% coming in from large cap stocks. 20% can be outside large cap category here. This portfolio has been in existence for last 15 years, and you will be surprised to know that despite last 6 years of flattish markets, in the last 15 years the fund has returned 15 times the original investment. It's a CAGR of 18.5% and an alpha of 6% over the 15-year period. So clearly, if you believe equities are for long term, and if you invest in portfolios like K50, which are long term in nature, I think there is enough money to be made. Moving to the next slide, where the portfolio action is presented. In terms of the key sectors, banking and finance at 29% is one of the overweight sectors, where we have overweight of about 2 to 3%. The major overweight in banking is coming from private sector banks and NBFCs. Public sector banks, we continue to be underweight. Other key sector is auto, which I have already explained. We continue to be bullish across our portfolios on auto. It's an overweight sector. Other 2 overweight sectors here would be pharmaceuticals and media. In terms of the underweight sectors, metals, oil and gas, utilities are the key underweight sectors. We believe that there is a lot of government interference, at least in oil and gas and utilities, wherein the profitability is not really determined by the individual companies, but more by government policies. So we are underweight in that sector. And metals, tactically we were overweight a couple of months back. We have made a reasonable amount of profits there, and we have recently reduced that overweight position into an underweight position. Moving to the next slide, which shows top 10 portfolio composition. I think these are all very well known names, blue chip names. There is nothing which is unknown to any investor. So clearly, as I said, this is a portfolio which is a pure blue chip portfolio, which will have lesser volatility compared to many other products that are there in the market, simply being a large cap portfolio. And as you would see, The large cap mid cap mix is clearly in favor of large caps. Large caps are at about 92% of the portfolio, and we believe that this is an ideal product for all those investors who are looking to re-enter equities, or all those investors who are conservative and would not want to take volatility of a mid cap product, or a slightly thematic product. So this is ideal for all those conservative investors in our view. Second product that I would like to discuss here is Kotak Select Focus Fund, which is in the next few slides. Moving to slide 17, this is a product which is based on the investment concept that at different points of economic cycle, there are different sectors and industry segments which do better than the market. The idea is to focus on those key sectors and build a portfolio. So the portfolio strategy here is a combination of top-down approach and a bottom-up approach in terms of stocks. Initially, we select a few sectors on top-down basis, and then try to get likely winners in terms of individual stocks in that portfolio. The portfolio also has a flexibility to move into mid caps. We can move anywhere between 0 to 50% into mid caps. So while it is focusing on sectors for outperformance over benchmark, it also has a flexibility to look at mid caps. So this product is ideal for all those aggressive investors who are looking to participate in the market in a more aggressive way, and look at getting some kind of a stability from large caps, and also look at potential kicker from mid caps. In terms of the sectors, we at any point of time will have at least 4 sectors and a maximum of 9 sectors. So while it is concentrated at the sector level, it is not concentrated at the portfolio level. At the portfolio level, we will continue to have about 45 stocks overall. So at the portfolio level, the investors will not see volatility in returns, because the concentration in sectors is quite very well balanced in terms of the number of stocks that we hold in the portfolio. Moving to slide number 18, why do we think such a scenario will make money for investors? I think we all know the foreign institutional investor money drives Indian markets in terms of movement. When you compare India with, let's say, some of the other nations like China, Taiwan, Korea, etc., what comes out very clearly is India has sizable number of sectors which are above 8%. There are 6 sectors in Nifty which are about 8% and above, which means that the investors have a reasonable amount of flexibility to move in and out of various sectors and play those themes. Whereas if you were to employ the same strategy in a country like Taiwan, that would not be really possible, because the top 3 sectors account for 72%, and the number of sectors which have more than 8% in the index are only 3. So to that extent, I think this strategy can work very well in countries like India, where there are sizable number of sectors with decent amount of weights, and we have seen that it has worked in the past, and there is some data that we want to show you in the next few slides. Moving to slide 19. It clearly shows that no sector consistently outperforms or underperforms the Nifty. What we have put in here is the calendar year performance of various indices like BSE Auto Index, BSE Bank Index, etc., etc. And at the bottom, you also have Nifty performance. For example, in calendar year 2002, Nifty returned only 3.3%, whereas BSE Auto Index gave 34.4%, and that is why it has been marked in green. So all those patches of green denote that that particular sectoral index has outperformed Nifty in that particular calendar year. So from this table, you can clearly make out that the business cycles last longer than what generally equity investors think, and they generally last 3 to 4 years at the minimum, and maybe even more in some cases. So the idea is to get into some of these outperforming sectors and try to be there in that sector until you find that the sector is overvalued. And even if you miss the initial part and the latter part, I think if you are in the middle of the cycle, and if you stay overweight in those sectors, I think there is enough money to be made and outperformance to be gained over the benchmark, and that has been the idea in this particular fund. Moving to the next slide, similar data which is presented on a quarterly basis. Again, the data shows that the trends don't change every quarter. It continues for reasonable amount of time, which gives enough time for fund managers to make the adjustments in portfolio and play those particular sectors and industry segments. Slide 21 shows various phases in the market starting 2008, when for the first time Nifty index hit more than 6,000. The same year it fell by about 60%, then again recovered back to 6,000 plus, and similar kind of moves have happened many a times in the last 5 years or 6 years. What comes out clearly from this is, moving to slide 22, in every phase there are different industry sectors which outperform or underperform by a clear margin, and if you are able to identify those industry segments, there is outperformance that can be produced. For example, in the period between January 2008 to October 2008, when Nifty fell 60%, some of the industry sectors such as FMCG, pharma, IT, they actually fell much lesser than Nifty by about 30 to 40%. And there were various other sectors like real estate, metals, consumer durables, for example, the top three worst performing sectors, they fell anywhere between 71 to 87%. So the idea is to zero in on some of these sectors in every phase and produce outperformance. It's not that this works only in a bearish phase. If you move to slide number 23, clearly, even in a bullish phase where Nifty gave 150% from bottom of 2008 to towards the end of 2010, clearly you will see that despite 150% returns, there were three sectors which actually give almost double the returns of Nifty: auto index, metals, and consumer durables. So in every phase you will have different industry segments outperforming and underperforming, and our focus has been to identify those trends. Moving to slide 26, it explains the thematic overlay that we use for any sector selection. How do we select sectors to start with? How do we know what is going to perform, what is not going to perform? I think clearly I can give an example of what has happened in this calendar year. I think people will resonate better with that particular example. When there was too much of pressure on our currency, when our current account deficit was very high and QE taper was announced for the first time and rupee started to depreciate, the only way we could hedge our portfolio or gain from that particular macro event was to have concentration of global companies or export oriented businesses in the portfolio. So the second example that we have in the slide, which is global versus local, so we tilted our portfolio towards global companies in that case, and that benefited our fund. Similarly, hypothetically, for example, if you believe that a government is going to be very conducive in terms of policies and it is going to reform the entire industrial scenario, you could be heavily overweight on companies or sectors which are dependent on reforms. So these are some of the various ways in which we can classify the initial themes that you would want to focus on, and then at the end of every theme and every sector, valuation is looked at, and finally if we are comfortable with the valuations, we tend to take those positions. Moving to the next slide, which shows asymmetric performance within sectors. For example, it is not only important that we choose banking or auto as a sector, we need to know which of the sub-segments within that is likely to do well, because the drivers in each of those sub-segments are quite clearly different in nature, and you need to focus on what is relevant at that point of time and whether it is beneficial or detrimental to that particular sub-sector. For example, the private versus state-owned bankings, these two particular sub-sectors clearly behaved in very different fashion in 2012, and even in year to date 2013 they have been behaving quite differently. The PSU banking space has continuously been underperforming private sector banking space simply because there has been concern in terms of non-performing assets as well as in terms of their capital structure. I think that has continued in 2012 and has become even worse in 2013, and trend shows that the banking index is outperforming PSU banking index. Similarly, in each of the industry segments, whether it is oil and gas, auto, etc., I think you need to differentiate between various subsectors and then take a position. And in select focus, that has been the investment concept. Moving to slide 29, it shows in the past how Kotak Select Focus has utilized this flexibility in terms of moving overweight and underweight in various sectors and how it has benefited the fund. For example, if you look at the top right chart, the underweight overweight movement in banking and financial is shown. If you look at January 2013, that's the beginning of the year, we were about 4% overweight. In fact, even if you move maybe middle of 2012, if you take that chart to earlier time period, it would look more or less similar. because that is a period, if you remember, was a period when interest rates were coming down, and there was hope that that interest rate cycle will continue to remain soft. And somewhere around May June period was a period when QE taper was announced for the first time, and RBI intervened in the short term markets, and the short term interest rate spiked, and there was a concern about the progress of interest rate cycle, and that is when we went neutral and later on underweight in that particular sector. And that underweight we continued till about last month, where we have bridged it almost to a neutral position now. And the chart below that shows the underweight overweight movement in information technology, which clearly shows when we went underweight on rate sensitives, we actually increased our focus on export oriented businesses. For example, IT was an underweight sector by about 4.5% in the beginning of the year. In July, August, it was an overweight of almost 7%, and we could clearly benefit because that was one of the few sectors which participated positively when rupee depreciated, and we are continuing to hold that overweight position. So that has helped the fund. Moving to the next slide, it shows how we have moved in segments like media, pharmaceuticals, telecom, etc. So there are a couple of sectors like media and telecom where we believe structurally the industry is experiencing change, and which is good from medium to long term perspective, and we continue to be bullish on that particular